The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is possible to lose principal and interest when investing in securities. No strategy can guarantee a profit or prevent a loss. The views expressed represent the personal opinions of the presenter or featured guests, not necessarily those of USA Financial or its affiliated subsidiaries. Any opinions or forecasting statements are subject to change at any time and without notice. John Cyndia is an investment advisor representative of, and advisory services are offered through USA Financial Securities Corporation, member FINRA SIPC, a registered investment advisor. Life Stages Advisory is not affiliated with USA Financial Securities. Life Stages Advisory, Dean or Remington, or any guest we have are not affiliated with USA Financial Securities. Welcome to episode 64 of WTF, Wealth, Tax, and Finances. I'm your host, John Cyndia, certified public accountant and personal financial specialist. Dean brought up a question the other day to me and said, what are options?
Tell me more, John. What are options?
I will. Stay tuned.
Okay.
We've got Dean, and if you hadn't noticed, Dean and Remington are in the studio today.
Hello. How you doing?
And we're not going to get real deep into this. We're just going to go probably at maybe a 10,000 foot level, not a 50,000 foot level. But we're certainly not going to be.
We're not going to talk about the iron condor.
We're not going to talk about iron condors or spreads or anything else. We're just going to talk about what options
the most popular Las Vegas hotel.
Yes, the Iron Condor.
Come on down to the Las Vegas Iron Condor.
Yes. What we're going to talk about is basically about puts and calls. And what you have, a call or a put, what it represents. So if you buy one contract of a call, we'll go with calls first. You buy a contract, it represents 100 shares of stock, okay? So these get priced out on what is called a chain, and it's an option chain. And when you get into the brokerage accounts that offer you or avail you to the ability to trade options, you'll go into your option chain and then see what the pricing is. And the pricing is made up of a lot of different things. And what you have to do when you first look at the call is to say, okay, am I in the money, out of the money, or at the money? So let's say we have something, first of all, that we have a stock that's trading at $100, okay? And if we looked at a 100 call, that is right at the money, okay? If we were looking at a 90 call and the stock price is at 100, we're considered in the money. In other words, there's already $10 of value there, all right? We got a 90 call. We're looking for that stock to go up. It's at 100, so we've got $10 of value in it. If we were looking for it to go higher, we may end up getting what we would look at would be, say, a 110 call. We've got the stock at 10. We're anticipating it going up to 110. It's going to be cheaper because it's out of the money, okay? So what they do is price them that the deeper into money you are, the more expensive. At the money is equivalent to you've got a 50-50 shot of it going up or down, basically. And then if you're out of the money, it's going to be a lot cheaper. Well, the reason you hear a lot of people using call options or even puts, if you're anticipating and looking at the momentum going up on something, you're going to have a call, usually, because I want that to go higher than what it is. If the shares of stock are at $100, I don't want to put $10,000 out there, 100 shares for a round lot, 100 shares at $100 at $10,000. But if I can control 100 shares with one contract, one option contract, I may be able to get that for, say, $2 is what the price of that option looks like. $2 times 100 shares would be $200, okay? So instead of me putting out $10,000 for the stock, I can put down $200, control that option, and look at if I have $200 and the stock moves, say, 5 points, I can turn around and make a lot of money. Whereas I went from 100 to 105 with 100 shares. Okay, I made $500. All right. Now, if we turn around and do something like that, I'm controlling $200, but I could make $500 out of that fairly easily, almost 2.5 times the money. So when you're looking at it, you can make an equivalent or more gain on that option than you would on the share of stock. So that's why they say, I don't want to buy the stock because I've got $10,000 at risk. I've had to put that down. On the option, I can control that same thing with $200. Okay. That's about as simple as an explanation as I can give you. But then you've got all these other factors that come in, because if I buy a stock and I'm either looking normally for it to go up and to have an increase, you sell stock short if you think it's going to go down. Well, if you're going to do that, you can buy a put. And a put is going to allow that contract to say, okay, that stock that's at $100, I think, maybe the market's long right now, and where we are currently, we're up at all-time highs. There's probably going to be a pullback at some point. That would be a good time to, potentially look at buying a put and saying, okay, I just want an SPY on the S&P 500, and maybe what I'll do is look and anticipate that. When I'm talking about this, I don't want to say that it's that easy to do. I'm just giving you a very, very simplistic look at how these things would function. You have to do your homework. You really have to understand the Greeks that I'll get into a little bit more here in a while, because you've got 4 or 5 other factors. You've got volatility, you got intrinsic and extrinsic values. You've got an awful lot of different factors that affect the market and the pricing of all these things. So calls, you anticipate the stock to go up. Puts, you anticipate the stock to go down. Okay, then you can do all kinds of different things. Instead of buying a call or a put, you can sell those. You can sell them for different types of premium and get those. And what you have to do is look at, what is it that I'm trying to do? Then they've got covered calls and certain things like this that, if you want to make extra income on. There's all kinds of different trading strategies. There's different kinds of, when we talked about an iron condor or a credit spread, you can do calendar spreads. There's all kinds of stuff.
So let me
make your
ask
head
this.
spin when you look at all that.
My head's already spinning anyways.
Yeah.
I feel like that meme with all the
lady with the numbers,
Pythagorean theorems flying past my head and all the numbers flying by. So when you're dealing with options trading, what's the time frame?
Well,
so can the time frame really be 1 minute? Can it be 10 years? Is there a time frame?
What you're looking at, excuse me, when you're buying, that's the difference in, when you got a stock, you determine how long you hang on to it. I can hang on to it. Day traders may hang on to a stock for 15, 20 seconds and trade it. Okay, because the difference in the spread that they're trying to get out of that, or the movement and the volatility of that stock.
Right. They want to make 15 cents now.
Yeah, exactly. And they've got 10,000 shares, and they want to take that little edge out of the trade and everything, and they do
right.
that. Or I can turn around, and if it's a dividend type stock, I might keep it for 25 or 30 years because it's got a 4, 5, 6% dividend on it. So there's no real, there's no time constraint on it. Whereas options do what they call expire. Okay, so you've got a specific time frame that you're looking at, and when you're looking at an option chain, normally you look at an option chain, and it might go, if the stock's at 100, you can have a normal chain that would maybe go up to 140 or down to 60. But you can look at everything to 0 and up to 200 if you wanted to. The thing is that when you're looking at option chains, they're going to give you a range and a time element that's in there. So you might look at like right now, we're in the end of April. When this airs, we'll probably be into sometime into May or whatever, okay? But you can look into, they've got weekly options, they got monthly options. Normally, I don't do a whole lot with the weekly stuff. I'm looking more on the monthly standpoint. But if you look a short term, if you're doing something short term, and you have to understand the time decay and all these other things that we'll get into with the Greeks, because everything affects that. So you've got time, you've got volatility. If a stock moves a whole lot up or down, that's the volatility in it, okay? If something moves faster up and down, or just the volatility itself could actually dictate the value of that option and could affect it.
So if something had a higher volatility, it might be worth more or less.
The actual option price could be affected without the stock really. The stock could be moving, say, from 100 to 120 and back down to 80 or whatever. It's a lot of volatility. Well, that could elevate the price of the option. So I could turn around and make money just off the volatility, and things don't have to really move a whole lot from the underlying stock that it's representing or the ETF.
Gotcha.
So like the volatility of, say, would be a lot higher than would be, because is a more of a staple for people, and it's not going to have a rocket up or down,
right?
A whole lot. On the other hand, is up, down. You could be up 15, 20 points in
and
an
right back down after
right
that.
Back down.
Yeah.
So the trading of that's the volatility up and down. So that's different. A different way to measure that. When you were talking about how long you have it, anything less than 9 months is just a normal option. Anything 9 months or over 9 months is what they call a leap. And you can get them up to like 2.5 years that you can go out and handle these. The difference is how that pricing goes. Now you've got intrinsic and you've got extrinsic types of value. So let's say, for instance, that $100 stock, I've got a 90 call, and that 90 call is now worth $10, just straight, because I bought it at 90, stock's up to $100. So that option is worth $10 to me. Okay, so that's my extrinsic or my intrinsic value. The extrinsic value would be then what was came from the volatility and all my the actual time decay, or the time I have left until that option expires. So say it was I bought something 6 months out, and I got maybe an October call. It's going to be worth more and cost me more in premium because there's more time in it than if I got something in May, a May call, because there's less time in it, so there's less time value. And that would be the extrinsic, because I have more time value and I have a lot of volatility. So maybe the price of my my $90 call, okay, could be, say it's priced at $12. For whatever reason, it's 12. Well, the intrinsic value of it is worth 10. So then why does it cost $12? Well, the rest of that $2 is made up of time decay or time value and the volatility of that. It could cost me 25. And if it was real volatile, it could cost me more. So, I was looking at some options a couple of months ago when I was looking at, doing something with, and you were looking at some of these that were just barely, I was looking at out of the money because maybe $10. So when it was like $700, I'm looking at 710, 720 because it was going up $50. So I was trying to find something what's out of the money. I was anticipating it going up to say 800. So I was buying it out of the money so it's cheaper. Then I started to look at some spreads and some different things that we're not going to get into, but it's still, I mean, you're still laying out $2,000-$3,000 for something. But in order for me to buy the Tesla stock, I'd have to put out 70, 80 grand. Okay. So it's a leveraging concept because I'm using a lot less money to put down, but I'm also able to make as much, if not more, because of that leveraging factor. And different things like the volatility of a stock is just going to, the price isn't going to change. If the stock is at 100 and goes to 110, and it did that quickly, and then it went down to 80 and came back up to 100, it's still 100. It's not like it's worth 200 because of the volatility in it.
Right.
It's just moving, and that price is what you're getting. The relationship between that option is different because of, we'll talk a little bit about it right now, is what we call the Greeks. You've got the main ones are delta, gamma, theta, vega, and rho. Rho we're not going to talk about because it's an interest factor and it affects leaps, something 9 months out there. It's like a carrying value that you have to have. So we're not even going to talk about that. But delta is how much does the option move relative to a dollar move in the stock. So if I'm at basically what they call at the money, so if the stock is 100 and I'm looking at a strike price on that option of 100, it's basically around 50 is the delta. In other words, it could go from 0 to 1. A put goes negative. It could go from 0 to a negative 1. So at 50, if the stock goes up from, say, 100 to 101, then I should capture at least 50% or 50 cents of that dollar move.
Okay,
on that option. Now, if it goes up $2, I should capture $1 of that. Now, the higher that goes up, or if I go in the money, say I go and I look at the stocks at 100 and I look at a 90 call strike price. Now, all of a sudden, that could be somewhere around 60, 65. So for every dollar, I'm going to get 65 cents on that. So the deeper in the money that I am, if I buy an 80 call, my intrinsic value is 20 because the stock's at 100. I've already got a real $20 value that my option is worth. So now all of a sudden, I might be looking at 75% of that move of every dollar into that. So you have to look to say, do I want to move more with that and get more out of it? If I was to go and buy a stock saying, well, I think that's still going to go up, I want to buy a 150 strike price. Stock's at 100, okay? That 150 may only cost me, say, 20 cents, okay? But I'm $50. I'm out of the money here, by 50 points or something. So, if I'm waiting on that on a short-term basis, either I know something or I'm an idiot. Okay.
Right. Yeah.
If it's
That's
something
a little bold of a play.
Yeah. I mean, you look at that stuff and somebody says, "Oh, I get them real cheap." Well, they never hit and they expire, and you're just wasting money.
Right.
So there's a lot of people that talk about a lot of different things, and there's a lot to know when you're doing this. It's not that easy, and I've gone to classes, I've gone to seminars, I've gone to workshops, I've paid for different types of services on this stuff. And over the years, I still like doing it. I've gotten to the point where I'm not, losing money. It's more consistently made. I'm not taking real big bets. I'm not doing anything real crazy. But I want to get into knowing more about, for this summer, of selling more options so I can take advantage of the income play off of that. We'll get to that in a second. So the delta is actually, if you're looking at that, it's the difference in that price move of the stock relative to that option. The next one would be gamma, which is how fast does that delta, how fast can that move with a dollar change in the stock? And that's prompted by some of the volatility and stuff. So if you look at delta as speed, the gamma would be the accelerator. So if I'm going faster and I can increase that price faster, probably influenced by volatility, okay? And when you look at the rate of change in the delta, what is that factor take into consideration that I can do it sooner, within that day, within a week, whatever you're looking at from that standpoint. And everything is relative to time. And when you're looking at the next one, which would be theta, is a time decay, and that's that part of that I was saying the extrinsic value. So if I have an option that's a month old, I've got X value in time. If I've got something in October, I've got maybe 5 times as much time. Okay, I've got 1 month. Now I'm looking at 6 months. Okay, so if my 1 month is only 50 cents, these are totally arbitrary figures, just for explanation purposes. If 1 month of time decay in this $100 stock is 50 cents, if I got something out into October, an October option, strike price is say at the money at 100, it may be $2.50. Okay, so now I've got this time on my side too. Now, if it's real volatile, the volatility might be worth $1. The time decay is worth $2.50, and the option price at the money might be $12. Okay, so I've got $15.50. Could be my option price, and I'm at the money. If I got that at $90, say, and it was still $15.50, $10 of it's intrinsic because it's from 90 to 100, okay? And then the balance of that is all made up of time value and the volatility side of that. So
it's almost like a formula to it.
It is. Right? Oh, yeah. Because when you start looking at this, you've got all these different things. You've got how fast is the market going up and down? Can it accelerate and go faster? Okay. I mean, the volatility is the amplitude. So I'm going up 10, 20 points, going down 50. But then all of a sudden I'm going to accelerate and it's going faster and faster. And the turnover and the acceleration of that is going. And as that happens, it's sort of, getting to the point, it's like, oh, geez, the magnitude and the price of that option can go. And as time goes on, what you can turn around and do is that time constraint is bad if you're long or you bought a call or you bought a put. Time isn't on your side because every day it gets less and less expensive. So that's why you take advantage of that with a different strategy of selling these options. So when I talked about a covered call, one of the probably the more simple ideas of that is to say, okay, I have an underlying stock. Okay, I've got 100 shares of whatever. And to keep it simple, it's, at $100. So I've got $10,000 worth of this stock. Yet I'd like to get some income off of it. Well, how would you do that? Well, it's by selling, you can turn around and sell a call. And why would I do that? Well, what I would do is strip that that premium that call. If I buy it, say it's a $2 premium, It's going to cost me $2 times 100 shares, $200. I could turn around and sell that and get that $200 in my pocket. Okay? Now, and I did that for, say, a month. Well, I've got 30 days, and I'm hoping that it turns around and expires, that it's worthless. So basically, if that stock's at 100, I want to go up here at maybe 110. Okay? Just a little bit out of the money. I wouldn't want to do it under that because it's already in the money. And if I sold it, somebody's going to turn around and try and buy that off of me. So what it would be is like maybe 110 and just slightly out of the money. So then they would have, the right to go ahead and buy those. You have a right to purchase $110. Okay, that's stock for 110. Where that comes into play would be if that stock at 100 all of a sudden in that month went to 125. But I sold this, somebody's going to cash it in and say, yeah, I want to buy that back at 110 because then it's worth 125. I'm going to make that $15 difference. So give me that. And then in the meantime, they'll end up having that take my stock. Okay, I have to be willing to give that up. Now, there's ways to avoid that with other options and have what they call, artificial covered calls and different things like that you can deal with just pure options, but way too deep. But
so basically what you're looking at with a put or a call, if I understand this correctly, tell me if I'm wrong, is you're looking for a right to purchase the stock at that price.
You have a right to purchase on a call. You have a right to sell on a put.
Yeah, okay. Yeah, so other way around.
Yeah. So now the thing is, if you've sold something, now you got to think about it. Okay, I already sold it. Now they got a right to buy it. Or I sold the put. Now they've got a right to sell back. Okay?
Right.
So it gets a little confusing when you sit here and it's like,
yeah.
hey, I bought that to give this up and I did that. So, and you got to make sure that, you're on the right side of that. Whenever you're doing this stuff, or, you're selling, a lot of times they'll turn around and sell puts in an increasing market, because if you look at it, what's the put for? The put is to go for anticipating something to go down, but I'm looking for it to stay up. So if I'm selling a puts, as long as the market's up, they're not going to make any money off of me. As soon as that turns around and goes the other way, then I've got an issue, because now I've got to turn around and I might have to buy something to sell it back, and you're just going to get messed up if you're doing
stock market gambling.
Yeah. Well, it's not. Some of this stuff is pretty consistent because you have to watch what the trends are. You've really got to watch the. You've got to be on something that's going to give you the option capability of doing that. You've got to be on a nice platform that's going to give you, daily, hourly, monthly, whatever you're trading in, okay? That's going to give you the ability to graph these things out, look at what they're dealing with. You've got to review whether or not, if it's just a straight put or a call play, because those are as basic as you're going to get. You're looking for a directional play. I buy a call, I'm looking for that stock to go up. I buy a put, I'm looking for that stock to go down. That's as simple as you're going to get. Then you start mixing and matching and saying, okay, I want to contain my cost. If I contain my cost or my losses or gains, then you start looking at spreads. And then you've got these different things. We talked about the iron condors, and you can get 4 or 5 or more different types of positions on some of these things, and you've got ways to get in and get out if it's going against you, and you trade, and
you're pretty much the more into it you are, the less riskier is.
Exactly,
because you might be leveraging yourself one way, but also leveraging yourself another way. So you're really not in a position really to lose any money, but also at the same time, your gains might not be nearly as massive if you were being risky.
Right. And they've got different things that if you were just to play, those are directional. If you had no idea where things were going, you could turn around and do some what they call strangles or straddles. And basically what it is you're buying a put and a call, and you're hedging your bet and saying, okay, it's going to go up or down or whatever, and I don't care because it's going to go off on one side or the other.
Right,
but
I'm going to make a little bit of money one way or
but
another.
It's just going to cost you a lot of money.
Right.
And basically, when you're looking at stuff like that, that's how some of these, you're looking at spreads on either side of that. And if you're looking at it, you can contain the money, but then they have to sit in a certain, an area. And if they go over or under that,
you're out big.
Well, it'll max out. It can restrict your, or at least contain your cost. So if I look at, what you never want to do is sell what they call naked. In other words, sell a put or sell a call, because if I buy something for $200 and it expires worthless, that's all I lost was $200. Okay, so if I was looking for a stock to go down and it went up, and I paid $200 for a put, I lost $200. If I had $300 for a call and I was looking for it to go up and the stock went down, I lost $300. Okay. If you turn around and you say, well, I'm looking for that, I just want that premium on that $300 call, and I sold the call, and it turns around, you could be unlimited on what you're losing, because I sold that at, say, 10 or whatever, and I was looking for it to stay down, and the thing took off. Well, it went to 50. Now I've got to buy that back at 50 because they have the right to buy it. Well, they're going to buy that 10 that I had because it's now worth 50.
They don't want the 50.
Yeah. No, I don't. They want that, so they're going to make the difference up because
Right.
I sold it for this little bit amount, and they're going to turn around and make that, but I got to buy that back. So when you start looking at all these things, it's like it can really, really, you're leveraged to the bad side, I guess is what I'm looking at. So if you buy something and it's directional and the market goes against you, that's your limit. If you're looking at something that still could be directional or it's within a range, then you can do these spreads. And then you can still, double, triple your money on these things. But there again, what happens if I'm out 2 months and I have this, I make this spread, it's a 15-point spread or something, okay? In other words, I went from a 100 to a 115 spread that I did for 15 points. I did that on a call spread, and I did it for 2 months. Nothing happens, but then in the third month it hits. Well, I've already expired, okay? If I would have bought a little bit more time, it would have cost me a little bit more, but I could have hit that thing. So you've got time against you on all these things.
Right.
So that's the thing. It's like, boy, I've been anticipating a pullback in the market for a few months. Well, if I was anticipating that happening in April, unless it happens this next week, and I was in, on a weekly contract that maybe ended up here the end of April, 1st of May, I've only got 1 week left. Chance of that happening probably slim. Okay, but if I had it into August or October, maybe we still got 3 or 4 months that market's going to correct.
You have a chance.
I've still got it. I could hit in there, and if it goes way beyond that, you just maxed out. In other words, it would max out your gain. If you hit below that, you're gonna, or in the middle somewhere, you're gonna make some money, but not max out the contract. And if you turned around and did something else, like you bought just a straight put or call and everything went in your direction, depending on when you, how far out you went. Say you ended up getting a, what's moved here in the last 6 months a lot.
We don't want to be specific, but
yeah. You had something that went from $100 stock in January and it's worth $500 right now. If I would have had a call on that, I'd be up 400 points. Okay, on 100 shares, I'm up big time with that thing.
Right, right.
some up 40 grand, and maybe it cost me $200 or something. So, there's a lot of money to be made into that, whereas I didn't have to put all that money up front.
Right. You didn't have to put the 100, 100 for 100 up front.
So that's why when you're looking at some of these people saying, yeah, well, I made, 2,000% on that trade. It's like, what? Well, on something crazy like that, you bought in at 200, it's worth 10,000. What's that? A couple 1,000% or whatever.
Right.
Whereas if I actually had to buy that, I had to put 10 grand in, and now it's worth 20 grand. I still have a 50% return.
Right.
But I had to put up 10 grand.
You had to put a lot of money up
I didn't
front.
have to put 200 out.
Right.
So, is it a poor man's trading? I don't think so. If some people said, oh, if you don't have any money, that's what you do this stuff for, or it's all speculation. There's a lot of people that make a lot of money consistently in it. And when you sell these options, it's mainly to provide income, or to, if you do have that contract go against you, then what you're doing is saving some of that money. Say that 100 shares was $100, and I sold something and I got, $1,000. Well, if it gets put to me that I have to turn around and buy that, or I have to sell something or whatever, instead of me now, I took $1,000 of premium that I got stuck in my pocket because I sold that option. Instead of me buying that stock for 10, I got to buy it, but it's only going to cost me 9 because I already got $1,000 back. So some of these are saying, okay, I'm doing that to buy it because I don't have a problem buying it at 90.
Right.
But I got a problem buying it at 100.
Right.
Okay, so if I do like the stock, then I can turn around and sell some of this premium, and then if it does get, shoved back to me that I've got to buy that, or, something else.
It is what it is.
Yeah.
You're in it.
So you got it. But if I like it, then that's fine anyway.
Right.
So, so you have to watch which side you're on and what you're doing from that standpoint, and then looking at it as one of these things that's saying, okay, do I want to pull income consistently? Do I want to just speculate, which is sort of nuts? There's all kinds of formulas. There are all kinds of software that can really, really dig into this stuff. And there's a couple of guys I've been following, one guy from like 10, 12 years that had these option software that I don't have it now. I'm looking to get back into it since I'll have more time after tax season. But he'll just go down, and he's got ways that his programmers have built algorithms to go and find different types of trades. He might just look at during earnings season. He's looked at that implied volatility, and a week before a company announces earnings, you'll see all these big spikes will come up right before earnings season. And it's like, get into it, a month ahead. I did that on one last week that I did. And it cost me, I think it was $170 on the contract, and I got out at $270. I made $100. It was something to see exactly what I could do, but I made $100 in like 2 days. I only had one contract because I was, trying to see if that was going to work based on the way he was talking, and it did. And I had another one that I was going to do, but I was a week out, and I just didn't get a chance. It had already they'd already announced earnings a week before, so I was a week ahead of it, and it didn't work. But you can scalp some of those things. You can do earnings season plays. You can do what they call calendar spreads, that every month on a certain date you can turn around and keep selling some of these calls or selling puts, depending on where you think the market's going. If you think it's going to stay up, down, whatever, what do you want to sell off of that? Can you get enough premium to satisfy what it is that you want? And if you can, that's another way to do it. I don't see many people doing all kinds of things like, trying to find a directional trade, putting on these other spreads, selling some of these, they're not, you're going to be proficient in one or two types of trades, and you try to stick with that. You don't want to go, oh, I can do all these big name things because it just sounds cool. You really have to understand where the market trend is or what you're trying to do in a certain type of stocks, because I've done the same thing. Years ago when I was really getting into it, I only followed like 5 or 6 stocks. And I've seen some of these people that are just really successful. And you want to have a stock that moves. In other words, that's volatile. Doesn't matter if it's going up or down. You want that sucker to move. If you got trades like that, then you can buy or make money or sell into that volatility or whatever. And because early on when I did that, I had one and I'm sitting there going, boy, this looks like a good trade setup. Excuse me. What moved against me was the fact that I was looking at it on that implied volatility. Volatility was really high. And it was higher than it normally is. So I bought it. I should have sold it because I got stuck into a volatility crash or a crunch. It went down. The stock went up. I should have been able to make money, but yet because of the volatility where I bought it, it offset my gain. And as the stock went up, I just sat there and I didn't do anything.
Right.
So if the volatility was lower and if I'd have paid attention to it at that point and the stock went up or I was more in the money, I would have actually made some money off of it.
Right.
But it went up. The volatility went against me. And because of that, I didn't make any money on the trade. I got out, from that, but I should have made money, didn't. So, it's one of these things that you have to really, really manage your risk on. And that's the other thing as far as the options and stuff, the risk management factor. People want to turn around and, like roll the dice like they're gambling and stuff. Yeah, give me 5 or 10 contracts or do this or whatever. And it's like, you get 1 or 2 contracts, whatever. It's all depending on what you have available to trade. And you don't want to trade anything that you don't have the capability of losing and not affecting you. So in other words, if you've got a $5,000 pool of money or $10,000 or $20,000, with $5,000, you may only want to look at I'm looking at maybe putting 5% on something like that. So $250 is the biggest contract or whatever. So if I have a contract worth 125, I might get 2 contracts because I got 250. It's like, boy, that looks like a good trade. I want to put 1,000 in. And that's 20%. You don't want to do that because trading and doing this has to be established. It has to be definitive, and it has to be specific as to what you're doing. Because as soon as you don't and you turn around and put something else toward it, you start chasing more risk and money and doing different things. So you have to be very diligent about what you're doing. And if you've got $20,000 and 5% of that's $1,000 and it's at $250 a contract, you can get 4 contracts, But you want to maintain your discipline into that with that risk management side, because it becomes very, very hard and difficult to try and make any money. If one time you buy 1 contract, the next thing you're going to buy 10, and you're going to all over the place. You stay within that 5%.
You need to be consistent.
Yeah, you have to do that in order to get to that point. But went over a lot of stuff there on that as far as you really have to go get some books just about basic options and understand where it's at.
You need some materials or something. I didn't think we were going to be getting into like a advanced course of stock market financing or financials or anything like that, but good Lord. That was a lot of information, but no, that kind of brings it all together and makes it have a little bit more of an understanding to where,
if anything, it hopefully scared you into reading before you went out and bought one.
No kidding. Because
I'm gonna have to watch this episode a couple more times.
Like you're talking about like some people, especially right now, currently in the past maybe few years, people stock market green button, press buy. No one does any research into anything. They're like, oh, it's going up. Time to press the button. Put my credit card in. I pay money. That's it. So this kind of like opens my eyes to it. It's like you need to really, really do your research and figure out what works for you. Because if this doesn't work for you, you shouldn't be doing it.
Yeah, it's not like this pump and dump stuff with some of the other stocks in the past here. Yeah, you're turning around buying that. If it goes up, fine. If it doesn't, or whatever. I saw something on there that it was on one of those online things that we won't talk about, that they had some stock going crazy the last few months. But it was funny because the kid said, man, I had 10 contracts and it should have gone up and I lost all my money, and oh my God, it was crazy. Well, what he had one of those volatility crushes, and he went and he just lost his shorts on this thing. And I'm like, buddy, you didn't even have a clue what you were doing.
Yeah.
And suppose he lost like $20,000-$30,000
oh my gosh,
that he didn't have. He borrowed all kind of money, sold everything, and ran this. And I just sat down and I go, yeah. Can you make money? Sure. Can you lose money? Absolutely. But and like I said, it was just something dumb that I did. I was looking at all this other stuff and getting excited and all that, and still didn't understand what the interplay was of those Greeks and stuff, because you can be good in two sections and then one other one turn against you,
and you're screwed. You were never going to make any money from the beginning.
No.
So you should have never made the purchase.
Yeah, they can work against each other. They can work with each other. You just really have to understand that. And once you get into a trade, and if you got a longer trade, like 5, 6, 7 months out, market's going to change. And it did go up. Did it go down? I can buy more. I can buy less. I can sell off. How many contracts do I have? What's going on? To me, it's fascinating. But even with all the stuff I look at, man, every time I look and I hit that button going, should I or should I? I'm still going,
this is a bad idea.
Oh my God, So, because I took a couple positions that I won't say what they are yet, but I'll let you know if they're good or bad in a couple of months. So we'll just have to see.
We'll wait and
revisit
see.
this. Yeah. But in the meantime,
all right, John, I think you're
get some books.
You're going pretty long here, almost at 50 minutes.
Oh, is that right? Oh my God. Okay.
Yeah, you like options?
No. Oh, yeah, I do.
You're interested? Yeah, no,
I do. I think they're cool.
I think this is good if anyone wants to stick around.
Yeah.
John will just keep on going.
No,
he's probably got
won't.
like 10 more bullet points on that paper.
We can actually segue that into, if you have any further questions that weren't mentioned in this deep dive, where can they reach you at?
Oh, good question. I'm glad you asked that.
Oh, yeah.
Jace India at lifestagesadvisory.com. You can see us on what?
Oh, we're everywhere.
On YouTube, on our podcast. We can, where else?
Apple Podcasts.
Apple
iTunes Podcasts. Same thing. Spotify.
iHeartRadio,
Google, Pandora.
Yeah, we're
turn
out
it
there.
on. We're literally on.
Just look for us.
Just turn something on.
All right,
share
sorry
with
went so
everyone.
late. I hope it was informative. Want to hear your feedback. Thanks. See you next time. Bye.